What is up, mortgage world? Happy Monday morning. Welcome to the Monday morning mortgage market meeting. It is me, your host, Sean Grapevine, director of Agent Direct, and I am joined this week, as with most weeks, by the one, the only, the Mac of the rate stack, the man who has his bips for breakfast, the guy who does best efforts with no effort. He's the Titan of the tenure, the Baron of Bips. He's the Lord of the Locks. He's a veritable ornithologist when it comes to the habits and habitats of Federal Reserve hawks and doves. It is the Austin Koenig. Welcome, Austin.
Thanks, Sean. Great intro as always, and it's great to spend another Monday here with you in the morning. And I think the habitat of doves and hawks that was a new one.
That's actually courtesy of a certain Rob Piclo. So you have him to
there
thank.
we go.
He unsolicited, but with many thanks and gratitude from me, sent me that after our meeting yesterday, and just kind of gave me a freebie there. So happy to have that one. Going to continue to workshop it as well, just add little tidbits here and there.
Love it, love it. Well, thanks again for hopping on. It's great talking the markets with you. We kind of joked before we actually started talking, 3.5, 10 years, kind of what we're sitting at. I think it's
3.5,
exactly
baby.
We're on the number.
Yeah, it's crazy. At this point, it's like it's not even a joke. It's axiomatic. It's a fact of life. Why is there some sort of market mechanism that is causing this, or is just like, maybe not necessarily why is it 3.5, but like, how can, in the sea of news that we're getting, there be essentially no net change to this number?
It's a great question, and I think Sean, to be honest with you, I think we'll have a lot of movement and pulls and pushes for rates to go up and down this week, as well as we kind of saw that last week as well, right? Like we saw a lot of movement up and down. There's things that are pushing rates in a kind of a confused direction, I would say, because there's a little bit of lack of clarity, right? I think the main thing here is with the debt ceiling that still was not really been resolved. With all the data we got last week, I would say inflation was not, in any way a bad news release. It was, I think it was generally met expectations, or, when we're looking at the producer price index, which is not as in focus, but, that one was even better. And, we saw initial jobless claims, go up, things that, fit the story of, hey, the Fed could really, put some reasoning behind pausing the next meeting. And now we know we have some more data that comes out before they meet again in June. But I think before that, we have to come to, some sort of an impasse here of do we default on our obligations as the U.S. government? Do we have a raise of the debt ceiling? How does that all get? That's one of those things that no one knows. It's a lot of uncertainty, and it's going to continue to drive uncertainty in the market until we get some sort of, hey, this is not looking good, or hey, we're getting close to a resolution here, or we do have a resolution. Nothing's really been given in terms of like hey, this is exactly what's happening. And I think generally the market doesn't like that, but they don't really have conviction of moving a lot of different ways because of that exact issue. So I think that's what's the big cloud looming over us and not allowing us to go beyond this range, among other things, with kind of lack of clarity of the Fed's next step. We think we do it. We think we have it, but we don't necessarily.
Wow. Okay. So basically, just a lot of things evening each other out in that push and pull. So let's talk about last week and in the CPI and PPI. That was last week, right? CPI was last week. It's all running together at this point. Where did it come out? Where was that? In comparison to expectations, and how has that affected people's outlook?
Yeah, so we talked about below 5%, right? And that's what the headline CPI showed was 4.9, so the closest you can get to 5%, but below 5%. And here's one of the things that I think is very important to look at is kind of the core CPI part of it is still kind of the hot part. Like core CPI is actually above regular CPI, and
Mhm.
so I think there's the services industry, kind of those services have stayed sticky in price. The housing, cost, cost of renting and all that sort of stuff. It's a lag to get into the data, and people understand that. But it is one of those things that does not really show up quite immediately, and that's one of those things. It takes time for that to kind of show up in the data. So we're going to continue to see that sort of play out over the coming months. I think where we saw a producer price index that looked good. It was, I don't have the number in front of me, but it was below expectations as well. But CPI came in at expectations month over month. It's a little bit lower than expectations on year over year, and I think generally it was not a bad print. It was just more so like, hey, there's this is kind of a step in the right direction. We still have work
Mhm.
to do, but is raising rates even more the answer? I don't particularly think so. I think the Fed probably thinks in the same manner of like, hey, we just need to keep it restrictive for a time being, but you can do that just by pausing. You don't have to hike. So that's kind of what clarity we'll need to see. And there's a lot of Fed speakers this week. I think every day I feel like there's at least 3 to 4 occurrences of a
Wow.
Fed member speaking in some sort of public manner. And so there's going to be a lot of market, attention paid to that. So there's going to be a lot of trying to manipulate sentences and words and how they said it. Um, and the market's going to try to discern some sort of direction out of that, on top of all the debt ceiling stuff.
Yeah, so tell us about the debt ceiling stuff. What's our time limit here, and how far away are the two parties on a resolution?
So I think the main kind of date that a lot of people have been told by Janet Yellen, who's the head of our Treasury, is June 1st, and it's actually kind of a guess. It's a best guess of that's the date we run out of money necessarily. So because you think of it like the U.S. government probably has it's like a huge company, right? Like there's tons of bills that have to be paid, and
Mhm,
there's
mhm.
tons of income that is going to come in as well. So there's different things that go on back and forth, right? They're trying to figure out which cash date they might actually not be able to pay the debts, basically not have the cash flow to do so. On that date, they need to be able to say, hey, we can go still offer more debt because we have this debt ceiling limit that we're going to hit, and we can't actually go out and issue more debt to pay our previous debts. So it's kind of one of those things. We don't know exactly what date, but it sounds like June 1st. So really think about 2 weeks from now,
Wow.
or maybe even sooner, we could theoretically run out of money. Um, and so that's kind of the issue at hand, right? Is trying to get that resolved before that date comes. And the treasurer is giving you a best guess, but they're basically saying, please work fast because we don't know how accurate that might be. And there's been some people that have speculated that it actually may come sooner. So obviously we have to keep that in mind as well. So it's going to be one of those things that can really impact markets because things such as the U.S. Treasury are considered a risk-free rate necessarily,
Right.
and that it kind of comes from the thought that they won't default on the debt.
Mhm.
So that's kind of going against that very old market nomenclature of the U.S. debt is risk-free, and that's just a kind of a tough spot to put ourselves in.
So consequences if we do miss payment or two. How will the markets react to that? What are the effects on uh fixed income, that kind of thing?
So I think the closest one, I was actually reading up about this a little bit, and the closest kind of, I guess, precedent to this is thinking about, '08 a little bit. There's kind of, I think, a similar instance in, 2012 area as well. But mortgages weren't affected as much as, let's say, equities and rate mark, like your traditional treasury markets. But I would say it's probably all going to get affected pretty harshly if this does come to fruition. and yeah, I would see rates go up in this case. There would be no
Sure.
reason why they
Right.
go down if that sort of thing
Right.
happens.
More risk, more higher interest rates. Right. That's the name of the game.
Correct, and it's going to be, some parts of the treasury curve. Obviously, we have things such as the 10-year we pay a lot of attention to, but there's a lot of shorter term, debt instruments that the treasury issues, and those might be even more volatile. So, I think keep in mind that's probably where a lot of the pain resides. Some of the longer term stuff may not be, but the shorter term stuff is going to be really wacky, I would say.
Interesting, interesting. All right, so we've got a few pieces of news to look out for today. Fed speakers stuff. If you want to be kept abreast of what Fed speakers are saying, what's the best place for people to read that?
I would just continue to read
Your
like
Bloomberg terminal.
I would say the MBS Live, like they end of day market recap in terms of just general things, what move things. If you wanted to kind of look wide rates, why do we get three rate sheets and why were they all worse today?
Mhm.
Go to MBS Live. They kind of give a good breakdown, as well as like there's even like trading economics. They have kind of like a market calendar you can kind of look at to an extent as well. And the same thing with like Market Watch. They also have economic calendars, but they also kind of tell you when each Fed speaker is going to speak. And in terms of like kind of what the gain from that speech, there's not a huge amount of analysis, I believe, but in terms of how it relates to mortgages. But MBS Live is, I think, a good source to kind of just see, hey, how did this move, the market necessarily, or did it move the market? If it didn't move the market, then they're probably not going to write much about it. But if
Mhm.
it did, they will. So that's a good place to go and take a look into that stuff.
Interesting, interesting. Well, guys, don't waste all your time. Reading the fine print. If rates go up, we're still the best choice. If rates go down, we're still the best choice. And if they say the same, if the 10-year is forever stuck at 3.5, then we are the best choice. Mr. Koenig, what about how are things there in capital markets? Anything we should know about upcoming products or lenders? Any tips and tricks you have for us in the trenches?
Yeah, of course. I think a couple things to touch on for this week. We should see two new lenders be officially announced this week. Some of the operations trainings going on right now. One of them is Acra, which adds to our non-QM lenders. I know we talked about this,
Yeah.
I think, the week before,
Uh
but
huh.
this is going to, kind of get announced and rolled out. I think we already have maybe one test loan going with them already, but just trying to get the wheels turning there. And then
Nice. I saw.
SunWest.
Oh, I
Oh, go
saw
ahead.
Acra offers a 5 to 24 unit DSCR, which is it seems like a nicely packaged intro to commercial lending for some of us at like what it was like 70 LTV or something like that.
Yeah, and that's exactly right. I think it's definitely still resi focused, but it has some of those bigger out of the box products with Acura, and that's why we're very comfortable adding them on too, because I think it adds a good product supplement to what we already currently have. But there's also more diversification of what we currently offer, and being able to kind of play the investors against each other. It obviously makes everyone want to compete for the business a little bit more. So I think at the end of the day, it's all good things. And SunWest is the other one. I think we're going to be, looking, especially if you're a VA LO, this is kind of something that'll be, really important to you as well. And there's going to be more details to come with SunWest as we announce it, but keep a lookout for those. And on top of, what we're doing from like a Monday market update standpoint, we'll start doing a daily market update, and Rob is going to be doing some of those this week, starting tomorrow. We will still have this as kind of our Monday staple, but that's something to keep an eye out for. And it's going to be short, going to be sweet. A couple things to keep an eye out for, or kind of just recap. But look forward to that. And we're going to have a lot of the other people within the capital markets team also helping out on that front too. So it'll be good to kind of get a fresh set of faces other than myself and Rob, of course. So it's going to be exciting to have that getting going and getting started, and it's going to start officially tomorrow.
Nice. Okay. Well, that's great. You heard it here first, folks. We've got some further communication, more regular communication from our capital markets wizards. We've got Acra coming on. We've got Sunwest, and they sound like they could also be an airline. So maybe they could. Anyway, I don't. It's early. It's Monday. There's no reason to say that, Sean. You gotta move on. Move on with your day, and you don't have to say everything that pops into your head. And we've got Fed meetings, and we've got debt ceiling negotiations. All things to keep an eye out on. I won't keep Austin or the rest of you any longer. And I think it's time that we all go out there and find some loans and lock them at all of our amazing lenders. Thank you, Austin, for being on with us today. Can't wait for next week.
Of course, Sean, thanks as always. And fly Sunwest for your next airline flight.
Hey, I sure will. Thanks so much.
All right, see you.